Hey everybody, welcome to episode 4 of the SaaS Report. I'm your host, Matt Aird, CEO and founder at SalesScience, and today we're going to be taking a look at the interesting decision by Klarna to replace Salesforce and Workday with in-house built AI applications. We're also going to be taking a look at some of the metrics from our Q2 SaaS metrics report, which is going to be released next week. We're going to take a look at ARR growth rates, magic number, and CAC payback and how those have changed over the last couple of years. But first of all, let's take a look at Q2 earnings announcements that have taken place over the last couple of weeks. All right, so starting off today, we're going to look at UiPath. Now, UiPath might be in trouble. UiPath is a robotic process automation company. So they help organizations to automate kind of like routine or repetitive tasks within their workflows. And they're in a position where they've got slower growth and increasing operating and net losses. So Q2 for UiPath was a rough one, just 19% ARR growth, down from 40% a couple of years ago, and increasing operating losses. So they had an operating loss of $100 million for the quarter versus $70 million loss from Q2 in 2023. NRR is also down, so down to 115% from 122% 12 months ago. And they're spending more than 60% of revenue on sales and marketing. So that's at the high end, right? Most of the companies that we look at spend somewhere around the 40% mark. There are some outliers, but 60% is a fairly chunky percentage of revenue to spend on sales and marketing every quarter. But with that spend, they're really struggling to maintain go-to-market efficiency. So what we've seen year over year is magic number is down 31%. So down from 0.35 to about 0.24. And CAC payback is up 60%, so from 39 months to 63 months in Q2 of this year. So as you might expect, the market isn't super happy with this, right? You've got slowing growth, you've got decreasing go-to-market efficiency, you've got increasing operating losses. Stock is down about 48% year to date, and they're trading at 4.4 times ARR right now. GitLab also reported Q2 results recently. So GitLab spent $97 million on sales and marketing in Q2 to generate $54 million in net new ARR quarter over quarter. So they're one of the most efficient companies that we track from a go-to-market standpoint. They had CAC payback of 23 months, which for anyone in startup land doesn't sound great, right? We know that the rule of thumb for early stage SaaS startups is around 12 months. For public companies, that tends to be a little bit higher, so 23 months is actually pretty good relative to the other companies that we monitor. And they've got a magic number of 0.58. So effectively, they're generating 58 cents in net new ARR for every dollar that they're spending on sales and marketing at the moment. Net revenue retention came in at 126%. That's actually up slightly from 124% in Q2 of last year. And they're making some cuts to OpEx, right? So they've actually reduced sales and marketing spend down from 66% down to 54% of revenue. They've reduced spending on research and development by about 5% and reduced G&A spending by about 13%. So a really big focus for them year over year in terms of reducing OpEx. And that's helped them to significantly reduce their operating loss. So that's gone from 54 million to 41 million in Q2 of this year. They've got a rule of X of 66, which puts them just below the top performers. So we looked at rule of X last week, this new metric by Bessemer Venture Partners, right? The gold standard there is 70, they're at 66. So a great kind of Q2 performance from GitLab, right? Improving go-to-market efficiency, reduced operating losses, good net revenue retention, and the market likes them at the moment. They're trading at 11.2 times ARR right now. Rubrik also announced Q2 results. Rubrik is on a mission to grow ARR, right? They're spending more than 80% of revenue on sales and marketing, right? Again, the benchmark for this for most SaaS companies that we track is around the 40% mark. They're spending double that. And it has been as high as 85% in the past. So that represented $168 million in sales and marketing spend in Q2. And they generated $63 million in net new ARR off the back of that. And whilst most companies are really trying to pursue this kind of, growth at a reasonable cost or fiscally responsible growth or whatever you want to call it, Rubrik is completely bucking this trend, right? So we know they're spending a lot on sales and marketing, but they're spending a lot across the board. So OpEx came in at 155% of revenue in Q2, right? So basically what that means is that if you combine G&A, sales and marketing, and research and development spend, that was 155% of the total revenue that they generated in Q2 of this year. So that meant that what they had for the quarter was an operating loss of about $170 million. That's up from a $73 million operating loss in the same quarter last year. On top of that, go-to-market efficiency isn't amazing. Now, you probably expect that, right? As you increase spend on sales and marketing, it can be hard to maintain the same level of performance, and Rubrik's certainly seeing that. So we've got a magic number of 0.34 and CAC payback of 50 months. That's up from 29 months in Q2 of last year. NRR is also down, but still strong. So in Q2 of last year, it was at 140%. It's coming in at 120% in Q2 this year. And they're just under $1 billion in ARR right now. So 919 million in ARR, trading at 6.5 times ARR currently. We also got Q2 numbers from DocuSign. So DocuSign is one of the OG SaaS companies at this point. They've been around for a long time. One of the innovators in the space, have really big market share, but what we're starting to see now is a little bit of a different picture, right? So what we saw in Q2 was $287 million spent on sales and marketing to generate $104 million in net new ARR. So that represents about 7% ARR growth, right? Taking them to about $2.8 billion in ARR. And so DocuSign is almost the perfect case study for what we've seen for these established SaaS businesses over the last couple of years. So from 22, they've seen growth slow substantially. So they've gone from kind of mid-20s, so 20 to 25% ARR growth in the middle of 2022. And that's come down to low single-figure growth rates, right? So 7% in Q2. We've seen this massive drop-off in growth rates post the COVID boom. And so to combat this, what they're doing is looking to improve operating margins, improve free cash flow margins, right? So we've seen a 700% improvement in operating margin year over year, right? So that's gone from a $6.6 million operating income in Q2 of last year to a $58 million operating income in Q2 of this year. And 27% free cash flow margins on top of that as well. So one area for concern for them is that NRR has remained below 100% for the third quarter in a row. So similar to ZoomInfo, right? We've got 3 consecutive quarters now of net revenue retention below 100%. Now that's definitely going to impact, as we've seen already, that net new ARR number, right? If you're churning revenue from the existing customer base, it means that you have to acquire that much more revenue from net new customers in order to maintain those growth rates. And DocuSign is really struggling to do that, as we can see at the moment. So slower growth, higher churn, right? Improved kind of operating margins and free cash flow. But the market isn't super happy with DocuSign at the moment. They're trading at just 4 times ARR. All right, Q2 SaaS Metrics Report is going to be live next week. What I want to do today for you guys is to do a quick preview on some of the core go-to-market metrics and have a look at how the companies that we track are performing today relative to 2023 and 2022. So what we're going to start off with today is looking at ARR growth rates and how those have changed over time. So what we can see here is a chart of roughly 30 odd public SaaS companies that we track, and we've plotted their ARR growth rates for Q2. So these are year-over-year growth rates for these companies. Right, and what we can see is that Rubrik leads the pack by a healthy margin here, growing ARR at 50%. And then you've got another cohort of companies around kind of the mid-30s, which includes Klaviyo, Monday, Atlassian, CyberArk, SentinelOne. And then bringing up the rear are companies like ZoomInfo, whose ARR actually shrunk year over year by about 6%. And then other companies that we've tracked in this podcast over the last couple of weeks, companies like Box and Zoom, are really struggling to generate top-line ARR growth right down the other end, right in the low single digits. Now, if we look at how that stacks up compared to prior periods, we can see that overall growth rates are trending down. So the median growth rates for this cohort of companies in 2022 was 43%, right? That's decreased to 22% for Q2 in 2024. And we've seen that, right? If we think about the companies that we've called out on this podcast over the last 4 weeks, we've seen almost unanimously that company growth rates are slower than they were in Q2 of last year, right? And if we go back a year further into 2022, they're even slower still. Now you can really see this trend magnified when you look at some specific company examples, right? So ZoomInfo, we covered back in episode 1 of the pod, right? They've got a negative 6% ARR growth rate right now. in 2023, they were growing at 16%, and in 2022, they were growing at 54%. So in 2022, right, they're literally on top of the world, growing at 54%, and that's changed a lot, right? The structure of the business has changed a lot over the last 2 years. They're now in a position where they need to figure out, how do we return to positive growth, right? Not just how do we increase growth rates, but how do we get back to a position where ARR is growing and not shrinking? So a pretty tough situation for ZoomInfo. All right, but they're not alone. You've got another company, Box, so 3% ARR growth rates this quarter. That's down from 15% in Q2 of 2022. You've got Monday, right? Even some of the better performing companies. So Monday was growing at 75% in 2022. That's down to 34% in Q2 of this year. SentinelOne was growing at 122%. That's down to 32%. The only company that we track that identified that's actually increased their growth rate from 22 to 24 is Palantir. So we reviewed Palantir on episode 2 of the podcast, and Palantir's fortunes are pretty tightly coupled to the state of like geopolitics in the world, right? If there's more drama, if there's more turmoil, Palantir is going to do well. We have our fair share of that at the moment, and so their growth rate's up slightly. So in 2022, they were growing at 26%. They're growing at 27% in Q2 of this year, right? So just overall growth is much harder to come by, right? Right across the spectrum. It doesn't really matter what industry you operate in. It doesn't matter if you're a newer SaaS company. It doesn't matter if you're more established, right? Growth has just been harder to come by this year than it was, last year or in 2022. And the reason for that is largely macroeconomic, right? We hear on these earnings calls, specifically, companies like HubSpot and Salesforce talking about much more stringent buying environments that their customers are operating in, right? Customers are much more cautious about spending money, and so that flows through into the growth rates that these companies are able to achieve. So if we look back at how the world was different in 2022, one of the key things is that interest rates were a lot lower, right? We've had increasing interest rates over the last 2 years, and this week we just had the announcement that the Fed is cutting interest rates, right? And so will this be the catalyst for the next round of SaaS growth? Well, we'll see, but it's probably going to be a good sign as money becomes cheaper. Typically that means good things for high growth SaaS companies. Next, let's have a look at magic number. So magic number is a metric that helps us to calculate go-to-market efficiency, right? How efficient is a company at turning the money that they spend on sales and marketing into net new ARR, right? Net new revenue that reoccurs for them. And so the way that we calculate this is we take the net new ARR that's generated this quarter, so the increase in ARR basically, and we divide that by the amount that was spent on sales and marketing in the previous quarter, right? So we assume that it takes 90 days for sales and marketing spend to influence the revenue line, and so we take the previous quarter's sales and marketing spend, right? Now, what we've got in this chart here is we've actually taken a last 12 months view of this metric. So basically what we've done is we've calculated this metric for the last 4 quarters, and we've taken the median of that to calculate what is the last 12-month magic number for each of these companies. So Atlassian takes the first place prize here. No surprises here really. They've got the most efficient go-to-market engine by a long way. So they're at $1.22 on magic number, which basically means for every dollar that they spend on sales and marketing, they're generating $1.22 in net new recurring revenue, right? You've also got Viva performing well here, so they're at 0.88. You've got Datadog at 0.86, and you've got CrowdStrike and Palantir coming in at 78 cents, so just below 80 there. So all performing well. And at the other end, you've got Zoom, you've got WalkMe, you've got Box, all under 10 cents, right? So think they're spending $1 on sales and marketing, they're only generating 10 cents in net new ARR. Now, we can see that some of the same companies that were on the far right-hand side, so at the low end of the growth rates, are also at the low end on magic number. And that's because SaaS companies typically spend somewhere between 30 and 40% typically, right, of revenue on sales and marketing. And so if you're not generating the growth rates, then magic number is going to be low, right? Because these companies are going to continue to spend that 30 or 40% on sales and marketing, or at least they have to date. And if you're just not generating revenue growth, then magic number is going to be low. So if we look at this trend over the last couple of years, what we can see is that magic number has gone from 0.72 as a median down to 0.47 over the last 2 years. So a pretty substantial decrease in go-to-market efficiency for these companies, right? A couple of standouts though, if we look at the magic number rates for Veeva, Datadog, and Palantir, we can see something interesting. So these companies weren't in the top 5 on ARR growth rates, but they are on magic number. So what that tells us is that they're not growing super fast, but they're doing it in a really efficient way. So Veeva generated 19% ARR growth while spending only 15% of revenue on sales and marketing. Right, Datadog grew at 27%, only spending 29% on sales and marketing, and Palantir grew at 27%, again spending 29% on sales and marketing. So these organizations are really efficient, right? They're able to turn modest sales and marketing spends into pretty strong ARR growths, right? And I think this is likely the trend that we're going to have to see some of these other companies try to emulate, right? Is like, if we're not able to see really high top line ARR growth, if we're not able to see the 40, 50, 60, 70% growth rates, then we need to find out how we can generate modest or moderate growth rates whilst only spending 20 to 25% of revenue on sales and marketing, right? Because otherwise we're just going to be a situation where, operating margins continue to compress. We've run large operating losses. We put pressure on free cash flow, right? So a lot of these businesses should try to take a leaf out of these, Veeva, Palantir, Datadog, and figure out how can we be a little bit more efficient, generate moderate growth, but not throw everything, including the kitchen sink, at sales and marketing expenditure, right? Similar to what Rubrik is doing, right? So they're growing the quickest, right? But they're spending, as we looked at earlier in this episode, they're growing at 50%, but they're spending 80% of revenue on sales and marketing to do that. So the other core go-to-market metric that we track is CAC payback period. Now, there's lots of different ways to calculate this, right? You can take the amount of sales and marketing spend to generate one incremental customer, right? Or you can look at the amount of sales and marketing spend to generate an incremental dollar in net new ARR. So what we've done is we're looking at CAC payback in terms of the revenue that's generated as opposed to the customers. When you calculate CAC payback on acquiring a customer, what you need for that to be informative is a really kind of homogenous customer base, right? Which means that every customer kind of pays you about the same amount. You generate about the same amount of revenue from them at about the same amount of margin. For a lot of the companies that we track, that can vary quite significantly, right? Some of them have, product-led growth models where they may have customers that are paying them, $20 a month. And at the other end of the spectrum, they've got customers that are paying them $1 million a year. And so to flatten that out and to get a truer understanding of how efficient their go-to-market engine is, we're going to look at the cost to acquire revenue as opposed to the cost to acquire an individual customer. So the formula that we use to do that is sales and marketing spend from the previous quarter divided by the net new ARR that's generated, times by the gross margin, times by 12 to give us the number of months that it takes to pay that back. And then we take that number for each of the last 4 quarters and we get the median to give us that last 12-month number. Now, any of you that are working in early stage SaaS companies, right, you'll know that the rule of thumb here is around 12 months. That's significantly higher for public companies, right, for obvious reasons, right? They've got a lower cost of capital. They're typically able to have much longer kind of like time horizons on investments to pay back. And so what we typically see here is like CAC paybacks are generally much higher than that kind of like rule of thumb of 12. So Atlassian takes the gold here again. So CAC payback for them currently of 14 months. And at the other end of the spectrum, we've got Zoom, right? So Zoom, if you believe this, has a CAC payback currently of 241 months, right? So basically what that means is it's taking them about 20 years to recoup the investment in sales and marketing from this quarter. Now, obviously that's not going to be sustainable for very long. So Zoom needs to figure out a way to either increase those growth rates or to cut that spend on sales and marketing. Otherwise, they're just going to be burning cash like nobody's business, right? We've also got WalkMe at a really high rate, so 167 months, Boxes at 160, Twilio's at 123, right? Some really extreme cases of CAC payback here for this quarter. And then at the other end, we've got some really good performance, right? So as we mentioned, Atlassian's at 14, Datadog's at 17 months, Veeva's at 19 months, Palantir's at 19 months, CrowdStrike's at 20 months, right? So on this end of the spectrum, really efficient go-to-market engines for public SaaS companies that have kind of like long-term time horizons, and at the other, companies that are really struggling to generate top-line growth and haven't made any significant cuts to sales and marketing spend. So in Q2 of 22, the median for the companies that we track on CAC payback was 22.4 months. That has blown out to 32.5 months as a median in Q2 of this year. And we can see that this is like impacting almost all of the companies that we track, right? No one has really had a stable CAC payback rate over the last 12 months. Even these really well-run companies are struggling on this metric, right? So HubSpot has increased from 22 months to 36 months in Q2 of this year. Monday's from 20 to 26. Snowflake has gone from 17 months to 33 months. Right? We're in this new paradigm right now where growth rates are just substantially lower, right? It's much harder to come by top line ARR growth. And unless these companies figure out a way to increase that, they're going to need to look at how they cut some of the fat from the sales and marketing line item. Because, for some of these companies, these CAC payback periods, these magic numbers are going to become unsustainable at a certain point. So one of the things that we'll look at next week is to just tie into this nicely is to look at how the percentage of revenue spent on sales and marketing has changed over the last couple of years, right? So what we should see as companies respond to these kind of lower growth rates, we should see a decrease in sales and marketing spend in order to compensate for that, right? If the market wants companies to be closer to operating income, to generate more free cash flow, then we should see a decrease in the spend level. So we're going to take a look at that metric and see how that's changed over the last 2 years. All right, so news came out this week that Klarna is canceling its subscriptions with Salesforce and Workday. So two of the OG kind of systems of record in the SaaS space. This is really interesting, right? So Klarna is a buy now, pay later company based in Sweden. They made the news earlier this year for having successfully rolled out AI into their customer service department, right? So they were able to, based on their reports, replace about 700 full-time employees. So they were able to use AI to solve about 2/3 of customer inquiries, right? So that meant they were able to replace about 700 full-time employees with their AI customer service agent. And what that did for them is it reduced customer service times from 11 minutes down to 2 minutes. And they're still maintaining, according to them, really high levels of customer satisfaction, right? So you've got this situation where Klarna early in the year made kind of headlines for this, and now they're looking to do it again. So the CEO came out this week and said that they are replacing Salesforce with an in-house built application and have plans to turn off Workday as well in the next couple of weeks. So as part of the release, they said there are large ongoing internal initiatives that are a combination of AI, standardization, and simplification. As an example, we just shut down Salesforce. Within a few weeks, we will shut down Workday. We're shutting down a lot of our SaaS providers as we're able to consolidate, the CEO said on a conference call. So Salesforce and Workday are supposed to be these systems of record that no one can disrupt. If you think about large SaaS applications, right, these are the foundation on which the business operates. So Salesforce will contain all of the customer data, right? So think all of the people that use Klarna as a buy now, pay later application, right? What have they used it for? What are they purchasing? How do we contact them? What is their transaction history? What is the customer support history? All of that would live inside of Salesforce. On the Workday side, Workday is a ERP and human resources management system. So think about this as all of the back office that they need to run the company, right? So their finances, their payroll, their employee records. These systems are supposed to be the things that you can't touch, right? These are the things that are undisruptible, basically. And Klarna has come out and said, hey, we're just going to build our own version of these. We're going to standardize, we're going to simplify the workflows, and we're going to do this using AI. So there could be a couple of reasons for this, right? Number one, and I think this is the reason that they point to, is that this is about kind of improving efficiency and reducing OpEx, right? If they're spending, $1.5 million a year on these two subscriptions, and they can rip those out and replace them with an in-house built solution, that's money that just flows straight to the bottom line. Now, how consequential that is for a company Klarna's size, I'm not too sure. They're still private, so we don't have any insight into kind of what their operating margins are like, how much they're spending on sales and marketing or G&A at the moment. But, $1.5 million per year, every year in perpetuity, I guess it makes a difference, right? So if we take that, reduce OpEx, cost improvement. The second idea or the second angle here is that potentially there's some efficiency improvements, right? So if we're using Workday and Salesforce, these are really large, kind of clunky solutions that can do lots of things. But often, an organization will only use, say, 10, 20, 30% of the application's total capabilities in managing their organization. And so there's a lot of kind of like bloat. There's a lot of like excess things that, users have to navigate around in order to get the jobs done that they want to get done. And so if you can purpose build a solution for yourself, right, that only does what you need it to do, then that can create some efficiency inside the organization. Particularly if you build these in-house solutions with AI in mind from the ground up, right? So there's a lot of talk about how AI can be used to improve efficiency within organizations. Salesforce unleashed at Dreamforce this week that they're introducing agents which are going to help to improve and streamline things inside the organizations. But if you can custom build something where AI handles, X% of the workflows for you without a human having to interact, then you can create additional efficiency, right? Especially if that AI agent is built specifically for your workflows, right? To update the systems in the way that you need them updated, as opposed to trying to train an agent that Salesforce has developed to work inside your workflow, right? So you see how there is potentially some efficiency gained here by creating something from the ground up, especially if you're creative around what AI does and what humans do for you internally. Now, this move obviously doesn't come without risks, right? Particularly, I think, on the Workday side. So Workday is in charge of managing a lot of the compliance obligations for an organization, right? Are we paying our people correctly? Are we keeping track of our finances correctly, right? Are we making sure that, when we get audited, everything is in the right place? Workday is the system of record for that. And so if you're building that from the ground up, you're going to want to be fairly confident that you're doing it correctly. So time will tell whether this is like a stroke of genius or something that they'll have to backtrack on in a couple of years as, HR and finance teams are scrambling because they're not able to do some of the core stuff that needs to be done. I think this also introduces some kind of wider implications around the SaaS ecosystem and AI in particular. So if you can replace Salesforce and Workday with an in-house solution that is kind of like built from the ground up with AI, you can replace any SaaS application, right? These are the systems of record that nobody should touch. And Klarna has just said, well, we're just going to rip these out and change it. One thing to consider here, and we don't know because we haven't seen, at least as far as I'm aware, we haven't seen how these things are designed or what the user interface is like. But I think one of the things to consider is that if we're moving into this age of AI agents, it's possible that the way that we interact with software changes fundamentally, right? So rather than clicking through screens on Salesforce in order to record or update information, it's possible that in the future we have kind of a single interface, which is an AI agent, which does a lot of that work for us. So if we think about it from the Salesforce point of view, right? You could have an AI agent that sits in on all of your sales calls. It takes the notes from that call. It transcribes those calls. It then goes and updates the required fields in Salesforce. It then creates a to-do list or action items for you off the back of that sales call. It then prepares an email for you, which you can then, review and hit send on. And so you can imagine a situation in which you don't actually need to interact with the CRM at all in the typical way, which is clicking through kind of contact and account and opportunity records. Instead, all you're interacting with is one kind of simple agent interface, and that agent is doing a lot of the work for you inside the system of record. Now, if that is the kind of new paradigm that we're moving towards, think kind of one single screen to interact with based on my job type, it is possible that these large systems of record will really face kind of the innovator's dilemma, right? Which is that they've built ginormous businesses. If you take Salesforce, for example, they're at $35 billion in ARR. They've built these giant businesses in this kind of typical SaaS profile, which is like you give someone a seat, they get access to the application, they can navigate around it and record the information that they need to inside of it. The way that you generate your revenue is by selling licenses and seats to people to use. In this new environment, right, I may never need to log into the CRM because all I interact with is this agent that sits on my laptop, right? And Salesforce is in a situation where they potentially don't want to cannibalize the $36 billion in ARR that they have in order to deliver this new paradigm, right? Google was in a very similar situation, right? So Google created AI effectively internally, but never released it, right? So apparently Google had a version of OpenAI's ChatGPT years ago. So many years before OpenAI released ChatGPT. But chances are they saw that as something that was going to cannibalize their cash cow, which was search, right? If you no longer need to run a Google search to find an answer to something and you can just type it into ChatGPT to get the answer, that potentially cannibalizes the billions and billions and billions of dollars of cash flow that business generates for them every quarter. And so they want to hold on to that paradigm for as long as possible, right? It's possible that these large enterprise SaaS companies are in a similar situation, right? We make so much money off delivering SaaS in the way that we deliver it that we're not going to be the one that makes the change because it's going to be too disruptive for the business to do it. The other thing to consider here is that this could potentially open up the market to earlier stage startups, right? If Klarna is able to create a substitute for Salesforce and Workday internally, then potentially, right, earlier stage startups can create something that is, AI native, that is much more streamlined, that helps large organizations to achieve the same goals, right, and sell that as, AI agent as a service or SaaS or whatever you want to call it, right? But productize the solution that Klarna has developed internally for its own use cases. And that creates a new kind of opportunity, right? We haven't seen these large systems of record in the enterprise space be challenged for a long time. And so if we're moving into this new paradigm where it's AI agents first, that's something to keep an eye on, right? Will we see a situation in which, Bank of America or United Airlines or whatever is getting rid of Salesforce for a solution that is kind of built from the ground up with AI as the core workflow? That's it for this week. Next week, we're going to take a look at the practice of acquiring venture-backed SaaS companies whose growth has stalled, right? Now, there's some interesting alignment problems that's created when this happens, right? Think a SaaS company that's come out, has raised, $20, $30 million, but for whatever reason, they're not able to scale, they're not able to grow into their valuation. That creates a situation in which kind of the founder and the investors are in a position where that company is worthless to them, but can have value to an outsider who could potentially come in and acquire that. So we're going to have a look at kind of that practice, the opportunities that might exist in that space, and some of the people that are following that path at the moment. And we're also going to review some more of the Q2 SaaS metrics report. So that'll be live next week before episode 5 of the pod comes out. I'll share the link to that report on LinkedIn and across all the other socials when it's ready. We'll do a deep dive next week on sales and marketing spend as a percentage of revenue, Rule of 40, and ARR per employee numbers and how those have changed over the last couple of years. Again, thanks a lot for watching. If you have any feedback, please let me know. I want to make this as interesting and as informative for you as I can. I'll see you next week. Until then, goodbye.